The second quarter of 2024 delivered a continuation of the global stock market rally that started back in October last year, once again led by US technology. The S&P 500 index reached a new all-time high, but the gains remained narrow as the equal-weighted S&P 500 index declined in the quarter, while the so-called Magnificent Seven US large-cap technology stocks were responsible for most of the returns. They rose another 17%. Equities continued to be driven by the AI theme, and the US environment was aided by US inflation numbers that continued their downward trend from last year after having been quite sticky in the first quarter. A few G10 central banks began to cut interest rates, but the US Federal Reserve remained cautious about the risk of inflation coming back if they lower interest rates too early, given the strength of their labor market and that in general financial conditions remain loose in that country. While at the start of the year, markets were pricing in an expected 7 interest rate cuts in 2024 from the US, that number is now only 2, and the first interest rate cut is only expected in September. Towards the end of the quarter, global economic data showed signs of cooling, with the economic surprise indices actually moving into negative territory. With the Fed expected to hold rates for longer than many other central banks, the US dollar continued to strengthen. That rose about 1.3% over the quarter. Real yields in the US remain elevated relative to the last decade or so. In South Africa, the focus in the second quarter was definitely our own elections in this country. Even though the ANC only managed just over 40% of the vote, and the MK party performed well, which was a scenario that worried us in the build-up, the ANC was, of course, still able to form a market-friendly coalition. We are particularly encouraged by this government of national unity, which we see as essentially a seminal moment in SA's democracy. If you look at history around the world, and particularly in Africa, it shows that the Revolution Party, which takes power post-colonialism or something similar, is typically unwilling to give it up when people express a desire for change. The fact that in South Africa we've had a smooth, peaceful, uncontested transition of power actually speaks volumes about the rule of law in South Africa, as well as the strength of our constitution and the maturity of the ANC. We are quite excited about the prospect of increased competition within government. We think it's very good for South African citizens, as it should probably drive improved outcomes. The new parties in the government of national unity will want to show that they can do things better, while the ANC themselves will feel more pressure to actually deliver. And given the low base we're working from, there's ample space to improve in this country. The politics have helped drive South African bond yields lower, with the 10-year bond now trading at an 11% yield. That's a full 1.5 percentage points better than the 12.5% peak in April. This shows how the risk premium built into our government debt has narrowed. So our central bank now has more room to lower interest rates, which should help the economy. In essence, we're excited by the prospect of the flywheel beginning to work in South Africa's favor. The stronger rand should help inflation, which provides further help to interest rates on top of expected cuts in the rest of the world. That then improves the environment for our consumers, which helps growth, which reduces South African risk, which can then help the rand and inflation and interest rates going forward, and hopefully the cycle can continue to move in the right direction. If we move then to asset class performance over the quarter, US equities dominated. The MSCI World and S&P 500 indices were up about 3% and 4% respectively over the second quarter. By contrast, European stocks fell 3% in dollar terms, but emerging markets did quite well, rising about 5% in dollars, certainly helped by the 7% return from China. From a style perspective, the growth factor performed best. That rose about 6%, and quality did similarly. Value lagged though, that fell about 1% over the 3 months. As mentioned earlier, global markets were very narrow. When looking at sectors, technology again led the charge. That was up 11% in the quarter. Most of the other sectors were in the sort of -1% to +1% range. Global listed property fell a further percent. Global bonds continued their lackluster performance. They fell about 1% over the quarter, meaning they've delivered less than 1% over the last 12 months. With inflation cooling though late in the quarter, we do expect bond performance to improve in the coming months. In the commodity space, oil rose 2%, while gold continued its run. That was up more than 4% over the quarter, despite a stronger dollar and delays in rate cuts, as strong demand from the East really supported that gold price. Our key question on gold now is whether the expected rate cuts can push prices higher from an already high base. When looking at South Africa, the rand showed the expected volatility around the election, ranging between 19.22 Rand and 17.95 Rand against the dollar. It ended the quarter 3% stronger, though, at 18.18 Rand. Our base case is for the rand to appreciate a little bit over the coming months. Our local equity market had an excellent quarter, really, rising 12% in dollar terms and more than 8% in rands. That's comfortably ahead of both emerging market and developed market peers. Within our market, financials recovered from a poor first quarter to rise over 20%, while industrials added 9% and resources about 7%. Our local bond market jumped almost 8% over the quarter, while cash delivered 2%. The House View equity model's performance over the first quarter was encouraging in absolute terms, rising 8% to really recover from the decline in the first quarter. Over the last 3 years, this portfolio has returned nearly 12% per annum after fees. That's about 0.6% per year ahead of the benchmark and more than 2% per year ahead of our average peer. So far in 2024, our exposure to Prosus and Bidvest has helped relative performance, while holding Sasol has acted as a drag, as did not owning Capitec, unfortunately. This portfolio remains in the top quartile of its peer group over 3, 5, and 10 years. Our worldwide equity portfolio unfortunately lagged its benchmark slightly in the second quarter, given that narrow global market that I spoke about earlier. While this portfolio has good exposure to the AI theme via businesses like Google and Microsoft, in general, its positioning is more tilted towards defensive names. The changes we made to the international component of this portfolio back in December to provide a more balanced global exposure are certainly working so far this year. If we move across to our Regulation 28 multi-asset portfolios, the short-term performance was quite encouraging. The balanced, moderate balanced, and conservative balanced portfolios were all slightly ahead of their benchmarks for the quarter, and that's on an after-fees basis, and they remain ahead of their benchmarks over 3, 5, and 10 years. These portfolios benefited from being overweight South African assets in the quarter, which obviously was painful last quarter, but helped this time out as the South African market rallied. In terms of activity in the portfolios, we did take advantage of the volatility around the elections to increase our exposure to so-called SA Inc. stocks. We did that in May. We added to Bidvest and Pepkor. And then in the balanced mandates, on top of that, we also added some exposure to private credit. Overall, our positioning across our portfolios is less defensive than it was 3 months ago, but is still slightly conservative given our concerns around valuation in the global equities space. When we look at global stocks, prices are still well above average on a forward-looking price-to-earnings multiple basis, while only the US economy is really doing well. The market is pricing in accelerating profit growth in 2024, which we think will be quite hard to achieve given our expectation that overall economic growth will slow relative to last year, and particularly so in the second half of this year. In South Africa, despite the recent rally, our market is still quite attractively priced. If the Government of National Unity can show stability and intent to do the right things, we would expect bonds to continue their rally, and that should also support local stock prices. Given the improved outlook, our South African equity holdings are now more balanced between South Africa Inc. type of stocks and more rand hedge exposures. Global equities still appear expensive relative to bonds. That premium that investors are being paid to take the additional risk associated with holding stocks versus bonds, that remains at around a 2-decade low. So by being more circumspect now, we're hoarding a little bit of so-called dry powder to deploy into more risky assets once prices maybe become a bit more attractive in future. In conclusion, we still believe that we are in the latter stages of the global investment and economic cycle. The US inflation has come down materially but it now remains to be seen whether it can stabilize around 2% without dragging growth down too far. We continue to try to construct well-diversified portfolios of high-quality assets for our clients that should be robust to a wide variety of outcomes.